Alright, guys, so we have another banking disaster on our hands. This time, it isn't a US bank collapsing, but a Japanese giant in trouble. This is the problem with higher interest rates today. The entire financial system is so connected that US monetary policy can break a bank halfway across the world. And because of this crisis, tens of billions of Western bonds are being dumped to save the bank. US treasuries and euro debt are being sold off, and this is a fire sale. Norinchukin Bank in Japan has to sell $63 billion worth of sovereign bonds. Why? Because their losses have tripled from 500 billion yen to 1.5 trillion. A major Japanese bank was chasing returns and they were betting tons of money on US bonds. And when interest rates went way up, they started to bleed a lot of money. Banks make a return in various ways. Most commonly, you issue loans to people who want to buy a house, or you issue loans to companies looking to expand. You pay almost nothing on deposits and you loan out money at 5 or even 10 times the interest rate. But not at Norinchukin Bank. They make money by speculating. The bank has around 31 trillion yen or half of their portfolio in bonds. And here's the important bit: more than half of their overall investment was in US dollars, which means US Treasury bonds, and the rest were largely in EU debt. And what have we seen over the last 2 years? The Fed and the ECB taking interest rates from near zero to over 5%. And when interest rates go up, bond values start to collapse. Banking is becoming a casino. We can forget about the traditional deposit and loan business. It's all about betting on stocks and gambling on interest rates. To stem the losses, Norinchukin Bank will sell off their bonds by March 2025. But from now until then, we could see more liquidations from banks globally. Even the ones in America are not safe. The FDIC found that US banks are sitting on horrific losses that are flying under the radar, and these are the unrealized paper losses. As of today, there are well over $500 billion worth of losses in US financial institutions. And you can't hide this mess forever. If the losses compound further and a bank becomes insolvent, we could see a massive collapse in confidence, and that could trigger the worst case scenario, another wave of bank runs like in 2023. It's important to dissect what went wrong in Norinchukin because this can extend to other Japanese banks as well. Higher interest rates, a stronger US dollar, and a collapsing yen all play a part in this mess. They are setting up the stage for a deeper financial crisis. Now, on the surface, Norinchukin looks like a typical agricultural bank. Their website tells us they are supporting fisheries, forestries, and food production of local communities. So you would think that they give loans to farmers and fishermen in Japan, but that's not how they make their profits. They are actually an investment bank buying and selling securities. We can immediately see these in their portfolio. Over half of their total portfolio comes from bonds, even more than their loans and stock holdings. To generate returns, Norinchukin is essentially a bond trader. But what type of debt do they go for? Not the local JGBs for sure. Japanese bonds give little to no return, especially with the central bank constantly buying them to keep rates low. Norinchukin has no choice but to go overseas and buy bonds from Europe and the United States. Yields there are much higher. If a Japanese bond is yielding 0% or even negative, getting a US Treasury that pays 2% is an awesome return. So they piled their cash and bought up a boatload of treasuries a few years back. In fact, 64% of their total holdings were US dollar and euro assets. Their exposure was tremendous. They need interest rates to come down fast so that their portfolio recovers. This is where things get sticky. Norinchukin gets their deposits and funding in the Japanese yen, and to raise US dollars, they need to pledge their yen assets. And when you pledge your assets, there's an interest rate cost you need to pay. When Norinchukin started borrowing US dollars, their costs were low. They were borrowing at the short end of the curve and buying longer dated bonds. So if you borrowed at 1% and you bought a US 10-year treasury that yielded 2.5%, your gain is 1.5% and this works out for you. There's a positive return. But when the Federal Reserve started raising rates to fight inflation, this entire strategy started to fail. The short-term rates flew to the moon while the long-term rates didn't catch up, and this chart explains it perfectly. The bank was borrowing US dollars at dirt cheap rates from 2020 to 2022, and these are the light blue and green lines here. And using the cheap money, they bought the 10-year bond in dark blue, so they were making around 1 to 1.5% of return, and this strategy worked out for quite some time. But rates started to go up. Now short-term rates are much higher than the yield on the 10-year. Norinchukin was borrowing at 5.5% now to get a yield of 4%. It doesn't make sense. So the bank was now losing money month after month, year after year. And this is the danger of a yield curve inversion. It doesn't just screw up the American economy, it creates a big problem for banks in Japan, elsewhere, investing in US bonds. And because of this inversion, Norinchukin decided to dump their bonds. They realized that the Federal Reserve might not be cutting rates anytime soon, and now is the time to jump ship.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings.
Powell essentially told the world that inflation is still too high, and the Fed is going to maintain their interest rate policy for far longer. In other words, higher for longer. So if you're the bank, it's time to dump your treasury bonds now, or your losses will continue to compound. But there's a catch. Now you are realizing those losses and your balance sheet will take a hit. Norinchukin is lucky that they caught it in time, but months down the road, we could have another bank suddenly collapse if rates continue to stay high. Japan could be the catalyst that takes down the entire system. The problem lies in the economy itself. Because of competition from China and foreign consumption, Japan is contracting. For 3 quarters, GDP growth has been either flat or negative. It's almost minus 2% for 9 consecutive months on average. And let's not forget that the yen is also collapsing. We are near 160 to the dollar. Prices are going up and consumers are giving up. They are going to spend less. This is embedded in Japan's culture. As a bank, it's risky to lend to companies. They might default. You have no idea when Japan's economy will recover as well. And even if they do pay you back, the returns are miserable, 1 to 1.5% at the very most. And this is a huge reason why banks like Norinchukin are playing the US bond market. There are few alternatives to make a decent return today. It's a complete mess in Japan. In a shocking report, Japanese investors are selling the most amount of US debt in 9 years. They liquidated $17 billion in a single month. And if things get bad enough, there could be mass selling on the streets. This could send shockwaves all the way to Wall Street and cause US banks to wobble. We could see another regional bank join the graveyard of First Republic and SVB. And this is the problem with banks today. It doesn't matter if it's in Japan, the UK, or the US. They are all the same. It's all about chasing yield, and there are only two ways to go about it. The first is to buy longer dated bonds. For example, instead of a 3-month treasury bill that yields 2%, you can buy a 10-year bond that gives you 4%. But when interest rates rise, your bond values will crash to hell. And this is called interest rate risk or duration risk. When the Fed started hiking rates, the value of Japan's treasury holdings fell like a rock. Before the hike, investors held over $1.3 trillion worth of US bonds. Within 12 months, it dropped by over $100 billion in value, and that's a fall of 8%. And if you're leveraged, as many banks are, your losses could be horrific. There could be a real systemic issue in Japan today. We just don't know. Norinchukin is just one bank. The second way to make money is to buy risky products, including derivatives. You would think that a bank would be more conservative, but nope, they are diving into the deep end once again. Norinchukin is considering buying into CLOs, which is a type of investment backed by a pool of debt. It's basically debt that is backed by other bonds. It's like a bag of potato chips where each chip is an individual bond, and that's how messy it is. Japan's CLO whale is about to take on even more risk. There are a ton of questions to be asked. What type of CLOs are they buying? Is this bond backed by commercial real estate debt? And where is this debt located? Are we talking about the US once again? Because if it is, that would be one risky investment. Commercial real estate in America is on the edge of a cliff. The share of delinquent loans in commercial real estate CLOs is surging. This means the underlying debt is facing repayment issues. In February this year, over 7% of loans were 30 days delinquent. Landlords just don't have the money to pay back their obligations. If enough of these loans default, the entire CLO bond will implode. It's 2008 all over again. And these are financial time bombs that could go off the longer the Fed keeps interest rates high. No true bank might be jumping into quicksand once again if this is their new strategy. And who's to blame for all of this? Now, I blame both the Fed and the BOJ, the Federal Reserve, for printing tons of money back in '08 and 2020 that caused the inflation crisis in the first place, and the Bank of Japan for suppressing bond yields to the point all the banks need to take big risks to even get a decent return. The only way to defuse this is for the Fed to quickly slam rates down. Powell needs to do it in a hurry because this problem is getting out of control. The FDIC reports another disaster is waiting. Higher interest rates have created 63 problem banks in the US, and there's $517 billion in unrealized losses. There's still an incredible amount of pressure in the system today. The assets of problem banks are also starting to rise towards the '08 crisis levels. Nearly $100 billion are under threat. Basically, the emperor has no clothes. All it takes is for someone to call the bluff. Powell needs to slam rates down urgently to prevent another wave of bank failures. So there are systemic risks building across the world. In Japan, it's because of the weak currency and the low interest rate regime. Banks are chasing yield there at all costs. And in the US, mortgage loans are time bomb as well. And time is running out. But let me know what you think. Are more bank failures coming? And will Japan trigger the next crisis? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.